Hello, everybody. Thank you so much for joining us today. Thank you so much for visiting. Probably give us several seconds to make sure everyone is connected with the audio and video and everything to make sure you're ready. Thank you. First of all, let me welcome you on our traditional event, our series of the events called Valuation and Portfolio Management Workshop. This year is 2026. We are happy to provide you with the additional series of such kind of events when we'll talk a bit more about valuation techniques, about investment analysis in very different aspects. Uh, uh, we are happy to welcome you on the side of CFA Society Ukraine. If you don't know who we are the Society of Investment Professionals with the highest standards of ethics, professional education, and professionalism in general. Today we will talk a little bit more about applied risks analytics with Python. This kind of understanding and measuring the risks probably remains one of the main components for the investment analysis and the valuation in general. That's why we have invited the perfect speaker, Yaroslav Niemirzycki, who is CFA and lots of different qualifications as well. And I think Yaroslav will tell a bit more about that. And I think we're gonna start. Please do not hesitate to ask your questions. You could use the chat. You could use raise a hand tool. So please feel free about that. In any kind of questions, we're here to help you. So not to take too much time, please, Yaroslav, this virtual stage is yours.
Thank you for the kind presentation. My pleasure to be here, and thank you for inviting me. As already has been mentioned, our topic is lays on the connection between Python, IT technology, and risk analytics, how to use the first tool to simplify our life with some calculations, interpretation, and using mathematical techniques to explain, to be better prepare for future risks. The future meeting will contain some sections. I'll try to represent some ideas about Python and its role in quantitative finance, why it's popular, etc. The next part of our topic will be connected to measuring different risk metrics using Python, using built-in functions from different libraries, or drafting our own custom functions to represent our internal view on risk perspective. And at the end, we'll use some popular technique to estimate risk based on Gotch models and using risk estimations to optimize our portfolio based on risk follow library from Python universe. Okay, as already mentioned, Python is very popular in the world of quantitative finance because of some strengths it has. First of all, we have a universal ecosystem. We use the same tool during the whole pipeline from gathering data and ending with backtesting or validation of our models. We can use get performance at scale. A lot of libraries used in Python actually is SC compiled routines, so they provide quite quick estimation, quick manipulation with data. And also we can use such technique as GPU acceleration, integration, other techniques and languages that we may need for our modeling, etc. The next The advantage of Python is the big, large ecosystem of machine learning integration. We have a variety of frameworks, libraries that provide us with routines to implement machine learning models, implement artificial intelligence techniques to forecast some financial ratios data, or just to solve some problems, including classification or forecasting problem, regression problem. The next point is the open source and of instruments used in Python, and the large community of developers who support different ready-to-use instruments to realize, to solve financial problems. The next point is the Jupyter native support in Python. Actually, this presentation you see as a Jupyter notebook, where we can see at the same time a text explanation, math and images, as well as some bunch of codes that can be run inside the document. Another strengths of Python is ability to use a different API with native API with data providers, with brokers, including interactive brokers, such terminals as Bloomberg, Icon from Refinitiv, etc. And of course, another point of Python as a useful technique is it cross-platform. You can use it on the different operation system on different devices, and it's low cost. Most libraries and Python itself is free of charge. We can use it freely. Next, I'd like to speak some time about main essential libraries that will be used during financial modeling. And let me start with the first one, NumPy. Actually, it's must-have library, and almost all your scripts with some financial modeling or analysis will start with such string as import NumPy as NP. This library provide effective, flexible, and quick routines for doing different math with your data. This mathematical functions is quite efficient, and you will get your result in most cases almost on the fly. The next library as a pair to NumPy library is Pandas. It's actually a library that provides you with such tool as data frame framework and different routines to manipulate data stored in form of data frame. It's quite efficient, and of course, in some cases, especially when we will talk about algorithmic trading or high frequency trading, you will need more efficient instruments that help you to get you provide low latency with your model, etc. But in most cases, when you just develop a model, testing some strategies, trying to understand its riskiness or efficiency, it will be more than enough. The next library is SkyPy. Essentially, it's a library that provide you with the tools for solving optimization problems. Many financial tasks or issues can be formulated as an optimization problem. For example, optimization of portfolio, where we try to understand which portfolio structure should be in respect to some expectation about our returns and constraints on the structure, on risk limits, etc. Many libraries use this library SkyPy inside providing a library can be used. We import this library into our environment and use some functions that can be found in this library. The next library is matplotlib. It's the main library for visualization. We will use it for display our results or our data visually to do some eye statistics to understand the behavioral data, how they are looked at, etc. Later we'll use it quite often. The next library is Skykit Learn. It's a library that provide us with different machine learning techniques with some estimations used for build this model, estimate parameters, test this model, validate results, etc. Another library is stats models. Here we can find a lot of models from statistics. Actually, in this case, we will probably will try to connect our Python with R, which has a strong backhaul in econometric especially. The next library is PyTorch. It's another library for machine learning and artificial intelligence. It provides a lot of models based on neural networks and how this model can be built, estimate, and used for prediction or solving some financial problems. Another library used for primary market risk management, estimating financial instruments, including their pricing, is quantlib. Actually, this library is written in C++, but we have some wrap around this library, quantlib Python, and we can connect to the quantlib via this library to use routines primarily for derivative pricing and risk estimation connected with these issues. The next two libraries is about strategy testing. First one is Vector BT. It's a library that helps you to test your trading ideas. When you have some ideas about trading signals, how they can be generated based on the data, your understanding of the market. And before implement this trading strategy into the practice and trying to trade based on this, you will probably need to test to get some estimation of quality of your idea. This library can help you to get the statistics and based on this make the decision about using it in investment or not. The last one from this first 10 libraries is Zipline. It's a library that can be used for testing trading strategy based on some events. you probably have some trading strategy, when you can select buy or sell decision based on some events, some signals, and this strategy can help you to realize your paper trading with understanding what the expected profit from this strategy can be, and what is the risk of your strategy. It's the high level of overview of the most popular libraries used in financial modeling in Python. It's not the best, it's just my view on the most popular one. Back into their ecosystem, I'd like to say that Python and his strength is the full ecosystem of tools and instruments that can be applied to all steps during your financial modeling pipeline. You can do everything inside Python without leaving it or switching to another tool, and that's quite easy and useful in general. Another point I'd like to say is some words about R as a complement to Python in terms of solving econometric issues or modeling using such techniques as GARCH for risk estimation, or performing some risk analytics based on such package equivalent of Python library as performance analytics. Actually, we can use Python from R and R from Python using such libraries as Reticulate or RPy2. Actually, you can see some examples how to connect these two tools in one project about model. Later, I'd like to present some risk metrics based on volatility. And before this, actually, from how to say, here you can see some picture. Actually, it's a picture generated by Gemini AI as a summary, visual summary for this presentation using maybe old school calculation of some financial ratios, risk metrics, but these indicators can be very useful and very efficient in decision making. Let me start with quite simple indicator as a historical volatility. Most risk metrics that we will see later is about volatility of some financial indicator, market indicator, and we'll try to calculate them using Python. Actually, what we need to do for this, we need some libraries that can provide us the tool to make all necessary calculations. First of all, we need to use such library as Y-Finance. It's a library that provides an API to Yahoo site where we can find a lot of financial data. And actually, all calculation today we will do using this source of data. In case you have access, for example, to Icon or Bloomberg Terminal, you can switch to this data source, selecting another library that connect to your data source and the appropriate functions to get data. The next library is a pair of NumPy and pandas. First one is for numerical calculations. The second one is for data manipulation, and ability to use data frame format. The first library is a matplotlib. It's a a tool to visualize our result and have ability to see the data in form of some graphs, plots. Our data will be for our analysis. I take the period from 2021 year to this moment of time. We have the ticker, the name of instrument based on which we will get data from Yahoo site. And the next command, we use function download, the ticker, and prices, including close, high, low, open, and volume of trade starting from this point of time. And ending this point where changes in prices. That's why we have not available, not a number mark in the first day of our data frame. It's just because we can calculate return for the first day of our period we take for our analysis. Based on this input data, we can calculate and can make our calculation whatever we want for our risk analysis. The next cell in this notebook is the routine that define the risk metrics, and the another lines of code is just a visualization of result. How we can calculate the historical volatility? We can simply use the function from NumPy package, which with name is standard deviation, from pandas standard deviation, and a square root function from NumPy library to normalize to analyze our daily volatility estimated in this part of our form. Actually, how we do this, we take our data frame. From this data frame, which named data, we created previously, we take just one row of returns and then split it into windows of 21 observations. For this 21 observation, we can calculate standard deviation based on based on standard formula from statistics. But as long we have daily data, this estimation will be daily standard volatility. The next step is analyzing this data. We use so-called square root of t rule to multiply daily standard deviation on square root of 252 working days in one calendar year. The next metric is use the same logic, but here we apply standard deviation not to returns, but to actually rolling volatility. So we try to understand the riskiness of our risk metrics. The idea behind this step is that we we are going to use that risk matrix which do not create additional risk of after calculations. And that matrix can show us the quality of our risk matrix. Once we do this calculation, we can compare all the data, raw data, and results of our calculation on this following plot. Here we can see a price of financial instrument, gray line, the risk metric, rolling volatility as a red line, and a blue line is the metric for quality of our risk estimation. The lower blue line means better quality of our rolling volatility. It means that we have quite stable estimation, and this results is in line with our assumptions that the historical volatility are quite close to the real volatility, and we can use this historical observation as a forecast for our future and use this number in value at risk estimation, for example, or just in portfolio optimization if we take the same logic to different instruments and get some risk estimation for assets in our portfolio. As you can see, just on get some insight about market dynamic, we can observe tomorrow and help to increase the quality of our estimation for the future and increase the quality of our forecast. So we may need some additional estimator for volatility that can incorporate all the available information. One of such estimator for volatility is so-called Garman class estimator. This volatility metric is based on 4 data from one day. It's low, high price during the trading session, and open and close priced for the same session. Actually, we can apply this logic not only for daily data, for any time frame, as we can get actually all this open, high, low, close price for any time period. It could be for 1 hour period or for a week window, etc. Here we can see the formula proposed for this estimator. This formula can also be applied on rolling principle from using rolling window, 1 interval in, 1 out. And here is the code that realize this logic in Python. As well, as previously, we use NumPy package for calling mathematical functions such as logarithm, natural, and some functions from pandas to manipulate data using some shifts. So we take previous observation from compared to the point of estimation, producing some rolling windows for our analysis, etc. Another cell is just about visualizing the result for this estimator, and here is the plot that we will get if we apply the Garman class volatility estimation to the same financial instrument. As you can see, the estimator, the result is more stable. The result in red, and this line has less noise compared to this one that we have previously. That's because we have additional source of information in our formula that help us to ignore some noise, but take the useful information can be found in this data. The alternative estimator to this one is a Parkinson volatility. This one is ignore open and closed data, so-called starting price for the period and ending price for the period, but concentrates on intra-period trading on high and low prices and try to estimate the volatility based on the fluctuation that was observed in a period, not on the edge of periods. The implementation in Python quite simple. In this case, all we need is NumPy for some mathematical formula, functions, square root, natural logarithm, power function, etc. And using this formula provided in the previous cell, we can get some function for Parkinson volatility estimation. The next cell is once again a visualization for the result, and we can see our results. In this case, we have a green line for volatility estimated based on Parkinson idea, and gray line here is the volatility of volatility. Actually, it's the stability of our risk metric, and the level of uncertainty around our estimation based on historical data and the ability to use this estimation as a proxy for future volatility. Another step or another indicator that can be used to understand the riskiness of some financial instrument or portfolio is a Sharpe ratio. Actually, we can try to compare the expected returns from the instrument with its uncertainty. And based on this, we can understand whether the return is enough to cover our risk, or we need to switch to another instrument as it more uncertain than provide some expected return for the next period. Here is the simple formula for this risk metric, and here is how it can be realized in Python. Once again, we use NumPy library for calling numerical functions, and some techniques from Panda library to manipulate data to get some data from a data frame for our analysis. And here is the visualization of the result. The main idea is the Sharpe ratio should be more than 1. In this case, the instrument provide more higher expected return than expected uncertainty around this return. For our instrument, we can observe the situation just now, the last part of our time horizon. Previously, the Sharpe ratio was quite below 1, and it's in terms of long position for this financial instrument. The alternative to Sharpe ratio actually is a trainer ratio. It realizes the idea that expected return for financial instruments can be sensitive to some systematic risks on the market. And in this case, this indicator can be useful in case we have some portfolio with hedged against systematic risk. In this case, we can understand how the portfolio rewards us for the beta we take, we invest in this portfolio. Once again, here is the logic for the calculating our rolling beta to use in our analysis in calculation of trainer ratio. And here is the calculation of trainer ratio itself. The other part of the cell code is just a visualization of the results. So we can see what was happening on the market in these terms. Here is the result, and we can see all three data simultaneously. We can see a benchmark. It's a green line. It's S&P 500 index. Blue line is our financial instruments used in this analysis, and red line is a rolling trainer ratio. The high ratio is the better, so we can see some periods when we observe negative trainer ratio. It means that the reward is quite below certain indicator is the rolling beta. Actually, we use this metric in this calculation as we need some beta for our portfolio or separate financial instrument. But here we can we try to see the dynamic of beta and as attempt to find some pattern in this dynamics. The mathematics behind the beta is here. It's just a ratio of covariance between portfolio or financial asset and the market divided by the variance of the market itself. And actually, we can have 4 different results. When beta is negative, it means that instrument is have qualities that contradict with the market. When the beta is equals 1, it's means that the asset follow the market completely. And two another scenarios is the beta between 0 and 1. It means that this instrument or our portfolio is less volatile than the market, while in case of beta higher than 1, we have the more volatile portfolio or asset under consideration. And depending on our expectations on our trading strategy, we can be interested in assets with beta higher than 1 or lower than 1. Here is the logic for calculating beta. We use simple regression, linear regression, but in this case, we try to use some estimator that produce more robust, more stable results based on the fact that we use some limited window for our estimation. That means that we have a limited number for estimation, points for estimation, and to reduce the riskiness of our estimation parameters, and beta is one of the parameters of such a linear regression, we can use some special techniques to produce more robust results. In this case, we use such techniques as Mansard regression and linear regression from Skylern library, especially from the part linear models. And here we use these techniques. We provide our model with market data. In this case, we use S&P 500 index, and our financial instrument that we used previously. And here we use not very effective, probably way of loops, where we try to estimate for every window with the length of 60 days, a new model, linear model with a new beta that was actual for this time frame, and store all beta after estimation and produce the following plot based on the beta estimation. Here we can see two different approaches to solve the same problem, especially estimating beta. In this case, blue line is a robust, more robust estimator Rendask, while ordinary least square method are provided with orange color. We can see that both estimators provide the comparable results, but the stability is quite different, and this can be valuable depending on the following use of this data. And finally, we are approaching to very popular risk metric as valued risk that provide us with some insights on the maximum losses that can be observed with some level of probability during the next time horizon specified before the estimation. In this case, actually, we have the formula that define such level of risk that could be observed only at some predefined level of probability, which is one of the parameter of the model, so-called confidence level. It's quite popular values for this parameter is 0.95 or 0.92. It's quite often used in banking regulation, where a regulator provides some requirements for this estimator And in this case, it could be, for example, the 10-day period with 99% of confidence level. Let's see how to implement this metrics based on historical simulation and the data we have from our previous steps. What we use in this case, we define some rolling windows for the same vector of data of returns, where we split it into windows of 252 observations. And based on this splitted windows, subsamples of observations, we define the quantile of 10, 5, and 3% to produce value at risk at 90%, 95, and 97% of confidence level. Actually, this is the whole model or the whole estimator for value at risk estimation based on historical simulation. Of course, we make some simplification in this case, as we assume that the history of this window will more or less repeat itself in the next period. And in this case, we'll have some quality estimation for our forecast. And later we have some code to visualize our results. And here is the results. At the right axis, you can see the level of value at risk. Here is some risk limit of minus 4% as probably risk tolerance for our position, and three quite similar lines, blue, light blue, dark blue, and purple, that define rolling value at risk at 90, 95, and 97% of confidence level. And we can see that sometimes we have position that is below our risk tolerance, our risk limit. Sometimes we have our position in line with set thresholds of minus 4%. The next step is the next metric is a conditional value at risk, as it's a development further development of value at risk concept. But in this case, we try to understand not the maximum, not the limit of our losses, but the average or expected losses in case of exceedance of the value at risk level. It means that conditional value at risk or expected shortfalls, as another name for this risk metric, is just an average expected losses in case when these losses are higher than the value at risk estimated previously. Here is the math behind this definition. And as well, we have two hyperparameters. First one is alpha, it's confidence levels, the same as we have here, would be 95%, 99%, or other level dependent on the regulatory framework or just internal needs. And the next, another hyperparameter is the time horizon for which we are trying to estimate this maximum expected losses over value at risk level. And here is the logic of the conditional value at risk in Python syntaxes. What we need to do, we define some additional custom functions that use NumPy functions to calculate average of data that belong to the quantile defined by confidence level. In this case, alpha as a 1 minus confidence level. And we try to find this 5% of observation from our rolling window of 252 observations, and average them to get the value for our conditional value at risk. Here we use these functions, or we can just define the function on the fly without storing it separately, but just inside the function we just call. And the next one, we drop all NAs in case of their generation. Another point for our visualization, we try to understand what is the average conditional value at risk for the whole period under investigation. And the letter code is just for visualizing our results. And here is our findings. Average green is conditional value at risk at 90% of confidence level. Blue one is for 95%, and orange one is for 97% of confidence level. And dotted line represents the average level for the whole period. Based on this, we can do some decisions, define our view on this metric, on the instrument, and etc. The next step is my trying to represent alternatives to volatility. Actually, volatility is based on the second moment, the distribution, the variance. But the distribution has another metrics to which can define or change their form of this distribution, and can be quite useful in understanding the risk in tails, so-called fat tails, for example, for financial returns. And this statistics is presented here. The first part is some mathematical formula for this metrics, excess kurtosis, bias corrected kurtosis, etc., skewness, rolling quantiles, etc. And here is the code that realize all this math into some calculations and giving us concrete numbers that can be used in our analysis. For example, to realize the metric of kurtosis on rolling basis, all we need is rolling functions applied to data frame with the column of returns, and function from NumPy which calculate kurtosis, which I apply to all these rolling windows. The same for skewness, rolling windows, source of data, and applying the function. The same for quantile function, autocorrelation, etc., etc. And the letter code is for visualizing our data into 5 separate plots, each plot for each parameter separately. And in this case, we can see, for example, based on the first lot of excess kurtosis, how is this how this matrix show us the dynamic of the asymmetry of distribution of our return. The higher asymmetry, the higher fat tail we can observe in our results, and that means that we can get unexpectedly high losses, which can eat all our profit from previous period. And in case we are try to escape of high risk, we probably will invest in the period of high level of tail risk for this instrument and invest in it when it has a lower metric for symmetry of the return distribution. Another way to see on fat tails of our losses, first of all, is so-called tail ratio. It's a metric that show the provide us with a view on the asymmetry in the losses and profits in the tails. And when the tail ratio is more than 1, it means that we have more positive big events than negative. So the positive tail, profit tail, is fatter than the losses tail. Here is the logic of this indicator in Python. Just this line of code. We try to define the quantile for the upper tail and quantile for the lower tail, for tail with profit and tail for losses, and calculate the ratio between these two tails. And all the following code is just for visualizing this data. And here is the tail ratio. In this case, we have Henry Hub futures here. It's a commodity future, so it's quite expectedly that it has another symmetry, high tail with price growth than with losses for long position. And here is mean that a long position will be rewarded higher than the short position. And another way to look at the same idea, the fat tails upper and lower one, is so-called omega ratio. It's the idea behind this ratio is that in this case we can we do not concentrate on some moments, variance, kurtosis, or skewness, but we compare two distributions simultaneously, and based on this we have in theory at least more correct comparison of two alternatives, profits and losses in our tails. Here are some mathematics for basic ratio and some explanations and manipulations with this ratio, and later we can find the implementation of the idea in our code. in this case, we can implement some minimum acceptable return. The logic that we see previously in Sharpe ratio. In that case, we use a so-called risk-free rate. In this case, it could be another metric, our expectation, our target, or the same risk return. And based on this, we can calculate omega ratio, trying to understand the asymmetry in distribution, not based on the mean or median value, but on the value that we are interested in. In this case, if we define MAR as a target return, we can understand the ratio between higher returns over our target compared to the losses below our target. Once again, we just use some technique from pandas and NumPy libraries, and here is the visualization for this idea. Once again, the results is quite comparable with tail ratio, as they try to look at the same idea, symmetry in comparison of our tails, but it could show us some different points, provide us with additional insights that can be used in our investment decisions. The next indicator is Sortino ratio. We know it from CFA curriculum. The idea is quite simple. We have some expected returns. We have the minimum acceptable returns, or our target returns, as well as we used in omega ratio previously. And we try to compare this exceed return over our target to uncertainty around our expected return. We can use different metric for uncertainty. It could be a downside deviation below target ratio, etc. In this, you can find some alternatives to the ratio, and here is the code that implement this ratio in R. Once again, we have actually just two lines of code to calculate our target metric, and the last of this cell is for visualizing the result. Here is some dynamics of the ratio in case of minimum acceptable rate at 0%. Actually, we take risk rate at 0%. The result is comparable with previous two indicators that look the similar idea behind the data. And next one, the next indicator in this part is Kalmar ratio. It's the alternative to understand the asymmetry between rewards and losses, profits and losses, based on so-called metric maximum drawdown. It's some indicators that show us how deep the bearish market could be in our instrument, and how many losses can be generated or during the period under investigation in terms if we take and keep this position through the period. What we have here, the ratio is quite simple. Annualized expected returns divided by the absolute value of maximum drawdown. And here is the logic behind maximum drawdown indicator. It's some trading alternative to value at risk maybe. In this case, we see maximum losses, but not at the end of the period, but through the period. Actually, this indicator provides some additional insight on intra-period dynamic of the instrument, how their losses and profits are accumulated during all the period, because we can have a low value at risk at the end of the period, but we can observe huge drawdown inside the period with the following recovery. But to take this recovery, we will need to provide additional liquidity to support our position that have some drawdown inside our period. Here is some math, and this is the realization of the indicator in Python, where we get some data, closed data, for the financial instrument, calculate the return for this time series based on closed data, and then we calculate Kalmar ratio for the same data. And here is the result. The higher Kalmar ratio is, the better from the investment point of view. It means that the expected returns over some thresholds is rewards us more than uncertainty could produce unexpected negative result for this instrument. But as you can see, the indicator is not stable, change dramatically from period to period depending on the market dynamic, and that's why we also can use this indicator as a trading signal if we can find some insight, some interpretation of these spikes into our trading strategy. From this spikes and implement this interpretation into our trading strategy. Another one is the quality of our returns based on return stability. Once again, here is some math behind the idea. We accumulated a return series, auto-regression based on the historical data, and later, and later you can find some explanation for the variable used in the model, and here is the Python implementation for this metric. Once again, it's quite long, but just one line of code with some on-the-fly defined function inside the call for other functions. And here is the visualization of the results. Once again, we have some insight on the quality of profit generation model for this financial instrument, and this SPICE can provide us with additional information. This indicator can be used as an input for other model, for maybe for market classification model, etc. Once again, other alternatives to value risk is maximum drawdown. Here is the same method you can find previously. And here is here is the implementation of the method in Python, just rolling cumulative return minus maximum on this period divided by the maximum return for this period. Actually, the indicator would be or zero in case of new peak on the market, or negative in case of when the price is below the last maximum observed on the market. And here we can see the market maximum drop of in price of our instrument. And actually, we can get this file, get this profile just using horizontal line that go through peaks of prices, and all below this horizontal line will define a drawdown for our position, and based on the maximum value for the period, we can estimate maximum losses inside the trading period, not at the end of the period, as we can see from value at risk, but the maximum losses inside the period depending on the trajectory of instrument prices. Another one is upside downside capture. It's another way to see on the tails of our distribution, long and short tails, two different indicator, one for upper tail and another for lower tail, one indicator for pain index. Here is some code and visualization of the result. That's all for let's put the point here on the risk metrics and try to get to look at some modeling using extra libraries from Python ecosystem. In this case, let's define the alternative values for volatility estimator, so-called Garch family. These models try to predict the changes in volatility based on the history of the volatility and the last observed returns on the market as new additional information not priced in previously, as it was not observed before this date. Here is the standard math for the model. Actually, we have the expected volatility for the future period as some combination of two uncertainty sources, one from the previous one, it's a memory term, and another one is from volatility observed today on the market or in this period, last observed period. This is the standard or basic Garch model. 1-1 means that we take only one step back for price changes and one step back for previous Garch estimation. And we can define some alternatives when we try to incorporate our insight on the asymmetry of market reaction to price changes. For example, for commodity markets or for financial instruments such as futures or instrument based on indexes, the market reaction is symmetrically dependent on the growth in price or losses. In case of financial instruments, losses can generate panics, and the panic will generate new losses. And in this case, our estimated volatility should be more sensitive to negative changes in price, while for commodity markets, vice versa is true. We can expect the more market reaction to growth in price than in drop in commodity prices. It could be realized, for example, through so-called exponential gauge when we have additional regression. Regressor mass for similar model based on Glonson-Yahernatan-Rankel idea. And here is some implementation using library Arch, which incorporate a lot of Garch models, types of Garch models, including different distributions behind the estimation, etc., etc. Actually, what we do here, we use Arch model from Arch library and define some rep functions that call the built-in functions in this model. First one will be used to estimate standard gauge. This simple symmetrical gauge with two components. Here we use the function from Arch library that define the next. We use the constant value for mean. Actually, it will be in most cases close to zero. We use type of model just gauge. Here is the legs for two components, one and one, and we define the distributions behind the model, the distributions that explain the uncertainty on the market. Here is the defined model, and here we call the fit function that which will calculate the parameters and all statistics for the parameters and the models in whole. The same formula for GR Garch. And the next custom formula that will use the results from previous two functions and do some forecasts based on their standard gauge and alternative gauge estimation. The next function is incorporate all visualization routines that we'll need to show the results of our Garch model. And here is the implementation. We use the same time period, starting from 2020, ending this month, 2026. We download data for S&P 500 index. We calculate returns of the index, log returns. The next one, we delete all empty rows in our vector. And then we feed standard Garch and alternative Garch model specification, do some forecasting based on the results, and then print the statistics for the model results and visualize our model. Here is the statistic for Garch, standard Garch. First of all, we can see all three coefficients, parameters of the model and their p statistics. We see that all parameters are statistically significant, and in the alternative model, we can find four parameters. One parameter, gamma, is for asymmetry, and the asymmetry is statistically significant. But in this case, the simple alpha coefficient is not statistically significant. That means that actually the financial instrument we are trying to analyze is reacting more on the direction on conditional volatility based on the standard Garch model. Another part of using volatility, risk metrics and volatility in Python is portfolio, is library risk portfolio that can help us to optimize our portfolio of assets based on the expected returns and expected risk estimation in respect to some constraints if we have such ones. This library provides four different objective functions. It means that we can use four different specification for our target optimization and 24 alternative risk metrics, including standard deviation, its historical volatility we used previously, value at risk, tail ratio, etc., etc. How to implement this idea in using Python and this risk follower library? It's quite simple. All we need is to import, first of all, create data set. We use some asset universe. Here is the triggers for some instruments. Next, we download all data and calculate the returns for all instruments for the time horizon. The next one is to import the routines from this library. And once we have this library in our environment, we create some portfolio using the declaration from this library, and the returns we have in data frame Y. The next point is how to define our estimation, logic for estimation of returns and risks. We use historical simulation. And next one, we call some statistic for all instruments in our portfolio based on defined logic of historical simulation. Here is additional parameters for our optimization, we use classical model based on Markowitz portfolio optimization, mean variance for risk metric. Another one, the indicator for our riskiness is Sharpe ratio, risk-free rate at 0 in this case, and some additional parameter that will be useful in when we use optimization based on utility functions, not on just average, not on expected returns. And the next one is just call an optimization routine for our predefined portfolio based on the parameter from this list. And here is the structure for our portfolio. All 19 assets have their own values in our portfolio. Here is the composition, including the most value of weights for our assets in our portfolio. Another point here is how to calculate efficient frontier for our risk universe of 19 assets. Here is the logic of this calculation, and we can find here efficient frontier for this asset universe and the optimal point for risk limit and combination of risk limit and expected return for our portfolio. And here is the changes in composition of probable portfolio based on this front line of efficient frontier, depending on our limit on risk we have for our calculation. This is the optimization results for the logic of Sharpe ratio as a risk metric. In case we are interested in another risk metric, we can just change the objectives for our optimization. For example, we can define the conditional value at risk as an alternative to Sharpe ratio. In this case, we state that risk matrix equals conditional value at risk and call the optimization routine with the parameter here, not Sharpe ratio, but conditional value at risk. And here is the result of optimal portfolio structure and the visualization for this structure. Here is the efficient frontier for the same asset universe, but based on our interest in conditional value at risk as a risk metric. And here is the changes in composition of our portfolio in case of different limits on risk limits on our position based on the value of conditional value at risk for our portfolio. Actually, that's all I'd like to show today, and I try to save some time for Q&A session. And now, if you can, some questions, comments, I'm yours. I'll try to answer a question or take your comments. Please, colleagues.
Maybe I can start. Do you hear me?
Yeah.
Okay, so thank you a lot for your webinar. It was very interesting for me. I've written my question in the chat, but I can read it once again. if it's possible from your side, because I've seen you were like like explaining how to use Python in all like quantitative equations and to classify risk and etc. I'm actually because I'm a CFA level 1 candidate, I'm also keen on quantitative finance, and I'm now trying to write some research paper. And I decided to analyze market shocks, and I've collected empirical data on S&P, Brent crude oil, and futures, gold futures. So based on my I was using only Excel because don't know how to use C++ and Python. So I've calculated monthly holding period returns and some averages, standard deviation, correlations, and covariances. And based on this covariance matrix, I've constructed minimum variance portfolio. And for this portfolio, estimated expected return, volatility, variance, and Sharpe ratio. And I decided to perform like a shock scenario analysis and stress testing, let's say whether it will be a downside shock on all securities or all instruments, or only commodity shock, I mean oil going down or up. And I recalculate portfolio returns and Sharpe ratio for those two scenarios, assuming a zero risk-free rate. Of course, it won't be zero, but still just to simplify it. And now I'm considering like adding Monte Carlo simulation in Excel, but based on what I'm doing now, I see that it just repeats my previous results, and I'm not sure whether it's a right like way um to update my research, or maybe I should use something else, but not in C++ or Python, because I'm still trying to learn programming. And I know maybe it's just a very big question, but if you would mind saying something or giving the feedback, I would appreciate your thoughts.
Am I correct that you have financial instruments, oil and
Crude
gas
oil.
in your portfolio?
Mhm.
Yeah.
So
I think that yes, probable explanation for the getting the close or the same result after Monte Carlo simulation is that you do not change, do not take into account the changes in correlation between oil and gas and other assets in your portfolio. That will probably be quite different in times of shocks. Now, maybe it will be useful to make some calculation of transmission between uh, commodities and financial instruments. In this case, you can analyze how your financial part of portfolio will react to changes in commodities markets in short-term perspective and long-term perspective. It could be done, for example, using co-integration analysis and using error correction models that can provide you with some transmission betas for short and for a long period, and maybe provide you with additional insight on the topics you're trying to use.
Yeah, thanks a lot. Thank you. And like last question from my side is about actually programming. If I'm zero at this point, where should I start? Maybe you can like maybe good online courses on these topics, because I know C++ is very effective because it works pretty fast, and in high frequency trading or anything connected with a topic that needs like fast response, C++ is a benefit tool. but Python also used frequently, and I'm wondering like how to connect both like languages, and where should I start based on the fact I'm just zero in this field. Maybe you know already like available courses on Coursera or edX or just general libraries for it.
Uh, okay, just thank you for your question. I'm not sure that I'm ready to name concrete course from any server. Probably you can start with some books like quantitative finance with Python or Python for finance.
Okay.
There are a lot of books on these topics. Most of books are followed with GitHub repo with examples from the book, code from the book. You can use it
Okay.
massage it on your own. It will be quite useful, and getting some knowledge in Python give you opportunity to understand when you need to migrate to C++ and how to do this better. But the point is whether you are trying to be a financial analyst with skills to implement models in Python or C++, or you want to be a programmer that create code some instruments in C++ for financial implication. It's quite different track as to me. For example, in last case, you probably be interested in QDC program,
It's Paul
quantitative
Vinton.
develop. Huh?
Is it this Paul Wilmot program, or is it not?
No. No, not a CQF. QSD, quantitative QDS, quantitative developer certificate. It's a certificate that provide a program with focus on developing high frequency trading models, trading robots, etc. Probably.
Yeah, thanks a lot. Sounds very interesting and inspiring, and it's like for me, it's like a niche topic. Everything connected with quantitative finance and not very popular in Ukrainian economic and financial sphere. So I'm working in finance and banking, but I only discovered quantitative finance by applying applying for CFA level 1. So thank you a lot. It was very inspiring, and it's all from my side.
Yaroslav, I see that we have a question in the chat. Will the notebook that you are presenting right now be published for participants? What do you think?
I don't see any problem with that. We can share it.
I think we can share it via email to all that have registered for this webinar. Okay, thank you. And then I have one question from myself. How do you ensure that the data that you use in analysis via Python is true, is valid, and how do you ensure its integrity and quality? So I know that right now there are many sources from which you can take data, and they are not really trustworthy. So how do you ensure that the data that you are using is integral? Thank you.
Thank you for your question. Very good question. Actually, in this presentation, I have ignored this step about data quality. Assuming for the simplification that the Yahoo Finance provide good data, it could be different strategies to check the data quality, including the test for outliers, trying to identify some unusual behavior data, etc. It's another quite deep niche in financial modeling. It's quite difficult to answer the question shortly. But there are another quantitative techniques that can be used for these issues, to solve these issues. And also there are separate libraries that provide routines, built-in functions to solve this data. But probably we can do another webinar on this topic to get to have more time and possibility to answer this question correctly.
Thank you so much for answering. Dear participants, perhaps you have other questions from your side? We also have one more question regarding AI. So, judging from the pace at which AI is developing right now, does it mean that in future all the codes, for example, for Python, can be written by AI? Will it be necessary for a specialist to see them, to analyze them, or can everything be outsourced to AI as well?
First point will be quite close to the previous question about data quality. At least getting some draft code from AI, you should be able to understand the code to make a decision, is it correct or not? Is it implementing your idea correctly or not? So probably AI is becoming a very efficient tool that help to produce code for model estimation or model development, validation, etc. But I'm not sure that can totally in any case, at least the user should be able to understand the results from AI system before to implement this code into production. So I see AI this stage as a good co-author of the model, but not the main actor on the floor.
Thank you so much. Dear participants, any question? In this case, I'd like to thank Yaroslav. Thank you so much for your time. Thank you for your effort, for this concise presentation, for the materials you have prepared. It was very useful to hear about such a detailed operations, how to use Python in finance. And dear participants, thank you for your time, for registering and staying here with us. We are waiting for you at our next webinar that will be on May 7th, the same time. So keep in touch. Any updates we will share with you, and we also will share with you the notebook, this notebook that Yaroslav has presented to us this webinar. Thank you so much.
Thank you for your time and your interest. Bye. Have a good evening.
Everyone, have a nice evening.
Thank you. Bye.